Good afternoon, everybody. I'd like to thank you guys for coming out for our monthly webinar series that we are putting on. This afternoon, I am really excited to have two individuals from T. Rowe Price, who I'm going to introduce here in a minute, come on and talk a little bit about the state of affairs that the markets are in, a little bit about 2021, and a little bit of a forecast looking forward into 2022 to kind of see where they believe the markets are heading and to try to help position the assets and the retirement accounts that you have with us in a way that makes sense. So as always, this webinar series for this month is going to be called the Market Update with T. Rowe Price. I always like to go into our little bit about Lincoln Investment. So on this call, I've got Kaylee Price and Paul Partridge, who are colleagues of mine. And Lincoln Investment's been around since 1968, primarily working in the 403B space, but now we're kind of doing a lot more of the financial planning, which obviously these webinars that we've been doing hopefully helps demonstrate some of our knowledge and some of what we're looking to educate you guys on. As you guys went over in the past, different topics that we cover: retirements, estate planning, insurance, education, all that stuff. But as I said, this afternoon, I'm super excited to kind of dive a little deeper and get a little geeky on the market side of things and, kind of what we do on a day-to-day basis and kind of where we see the world heading. So I'd like to kind of introduce two individuals. One, I have Lauren Moser on this call. Lauren is our internal. She works with Paul, Kaylee, and myself in terms of getting information about the funds, setting up these type of presentations. And then we also have Ryan Gemmell on. Ryan's the vice president over at T. Rowe Price. Ryan, I believe, and you have your CFA. He basically works on the international side, but he's going to kind of go over their strategies, how they kind of pick and choose the funds that they do, and kind of where they see the market heading as a whole. Ryan, I'm probably grossly undercutting everything that you do. But as I said, I'm super excited to have you come out and hopefully educate some of our staff, our employees, or not our employees, our participants and our clients on the markets as a whole this afternoon. So I'm going to kick it over to you.
Well, thank you very much. I really appreciate the opportunity to speak to you all, especially given everything that is going on in markets today. So I guess just to start off, just to talk about a recap of 2021. It was a really interesting year in a number of ways. We really thought about it as a transition year from the height of the pandemic in 2020 to what we're building towards and hopefully what will be a bit more of a post-pandemic feel in 2022. But it was also a year that was defined by a lot of knock-on effects due to what happened in 2020. A lot of the efforts that we governments put forward to combat the pandemic in 2020. So, going into 21, we had really massive amounts of stimulus. We had the vaccine development and distribution that was starting up, a lot of economic reopening, and then central banks were keeping a lid on rates. So going in, it was a pretty Goldilocks environment. Really resulted in developed markets, especially in Western developed markets, really having strong performance. Again, this year, emerging markets did quite well until about August of 21, when China started to implement some of their regulatory measures that really put some downward pressure on China and some of their bigger tech names. I'm sure you've heard things like Alibaba and Tencent, names of that nature. China being a major driver of emerging markets and especially Asia, that brought down emerging markets. It brought down Japan with it. But overall, markets were positive in the developed world, especially Western markets like Europe and the US. But a lot of the measures that were put forth in 20 and 21 started to have some knock-on effects. We started to have really extreme inflation, and we started to have very, closely related, I should say, were supply chain issues. And that led to what has been the main question for the year, and what's sort of been a driver of the volatility in 21 was essentially, what will the Fed do? What will other central banks do? When will they start to taper, and when will they raise rates, if at all? But ultimately, the Fed and other central banks remained very accommodative, and that allowed markets to rise despite some of the issues that arose during the year, like Delta, inflation, supply chain issues, geopolitical tensions, and really, some of the high market valuations that were concerns for part of the year as well. But markets chugged along. There was still a ton of money in the market, a lot of stimulus, much of it at the consumer level, so a lot of really good consumer spending. Corporate earnings were very strong, and all these measures helped to keep markets afloat. Unlike 2020, though, the performance was a bit broader when you start looking at the company sector industry perspective, where in 2020 it was a very growth-oriented market where your big tech companies, a lot of the e-commerce, like in Amazon, were really the big beneficiaries as the world moved from an offline to online scenario. Where in 2021 there was a push-pull between, is it COVID on or COVID off? Things were going really well for your more value, cyclically oriented companies, your financials, your energy, your airlines, hotels, autos, etc. These were doing really well in periods that coincided with lower or decreasing COVID rates. Talk about some potential increase in yields that benefit financials, better economic data, whether that was strong industrial production or things like machine tool orders, versus in periods where you had, when the Delta variant came out, you saw a sell-off in some of those areas because of fears of, oh no, here we go again. In the pandemic scenario of, we're going to go back to online, things are going to be locked down again, yields are going to stay really low, growth will go back to being low. So more of a push-pull in terms of the sectors that performed in 21, but overall, again, really quite positive. But as we start to move into 2022, that big question about what is the Fed going to do, what are central banks going to do, and the risks of inflation are still there. That's really the main question that we have, I would say, among three things that we're watching. So again, the first being sort of this growth versus inflation dynamic. The second being around fundamentals. So we're looking at valuations versus earnings for companies. And then lastly, about central bank policy. So as it relates to that Fed rate inflation issue, Fed and other central banks, they've been calling inflation transitory really until recently by the Fed. And because of that belief that supply chain issues would be temporary, in the sense that once you have some manufacturing come back online, your supply chains work themselves out, where the one component that goes into a product is able to be produced, and then that helps the next one in the supply chain, then it helps the next one in the supply chain. If these issues were able to be worked out, then it wouldn't be persistent inflation. And that's really how the Fed defines inflation, is rising prices over a period of time. So for them, that period of time really hadn't come through yet. And if you weren't getting compounding inflation or compounding price rises on a year-over-year basis for a consistent period of time, then they weren't really viewing that as anything more than transitory. But now we are starting to rethink that. And of course, we may have some alleviation in some components of inflation, like autos, where if we're able to get some semiconductors and the production of cars back online, you could see a pretty strong price decrease in cars. But there's also a structural component to this, in something like housing, for example, where the supply is just not there compared to the demand. You have really strong consumer accounts. Everyone's balances are up, the stock markets are up, your housing value is up, and that is elevating certain asset prices like the stock market and housing. And that type of inflation is something that could persist. So how do central banks begin to combat that, because they kind of have to balance two things. You know, the first being, do we want to temper rising inflation? And that's typically done through raising rates. But we're also in a scenario where growth is potentially slowing down, where we have reached peak stimulus. The amount of money that the government is putting into the market, and not just the US, but globally, has really peaked. So as that money starts to be drawn out of economies, it can have a slowdown effect. So if the central banks feel the need to raise rates, that can add on to a slowdown in growth, which can have a negative shock to markets as well. So that's something that we're watching, is those two dynamics. And even within that, I would say three components that we're keeping an eye on are consumer balance sheets. You know, so how much savings do consumers have? As of now, it's still quite strong, so consumers can still support economies through their additional spending. Corporate balance sheets still remain strong, and we think that's going to be a factor in terms of companies' ability to spend on new projects and initiatives, continue to hire new folks and new employees. And then lastly, that transportation and supply chain issue. You know, is that able to start to work itself out as factories stay open longer? That means that they're able to produce the components that are needed. And again, that kind of flows down in the supply chain, where if you're missing any one component, the whole thing can't be completed. You know, there are cars that were not being moved onto lots because they were missing $1 semiconductor chips. If those things are starting to alleviate, and even the transportation issues that you hear about in terms of the shipping costs and container ships, which we are seeing signs of easing, but if those things continue to ease, then those will all be supportive growth measures, and should alleviate the need for central banks to make any drastic moves. So secondly, from the fundamentals versus earnings, earnings globally have been really strong, especially in the US. It's one of the reasons why markets have performed so well over the last 18 to 20 months. But we're also at a period where it's potentially hard to see that earnings growth begin to accelerate or continue to accelerate. Margins, more specifically operating margin here in the US for the S&P 500 is at a record level. So the starting point for earnings is difficult, and a lot of the performance that you get out of markets is due to earnings growth. So if we're not able to continue to experience really strong earnings growth, then there may be some reckoning with some of the higher valuations that we're seeing across equity markets. So we think that it's going to be really important to be very selective in companies that you invest in, not just in the US, but globally as well. And also, in our view, lends opportunity to investing outside the US in areas like Japan and emerging markets, where they've lagged a bit of the recovery because they're more cyclically oriented, had a lot of negative effects from the Delta variant, had a slower vaccine rollout, have had political and regulatory headwinds in both Japan and China, respectively. But the valuations are very attractive. If the recovery is able to get back on track, a global recovery, and we're able to get some of this industrial cyclical production back, then those two areas of the market should benefit. And then lastly, and this really all ties together in terms of what we're looking for or looking at in 2022, is central bank policy. And this goes back to that inflation part. But as valuations are elevated and inflation pressures mount, there's greater potential for a policy misstep from central banks. You know, if they let inflation run too hot, it can be really hard to contain. Inflation is something that typically doesn't behave rationally or, you know, in any type of uniform manner over time. But if you raise rates too quickly on the other end to tamp that inflation, and again, that's more of a negative effect on growth for economies. So we're trying to look at these factors in terms of balancing the inflation, the supply chain issues, the central bank policies and how they react to those versus the economic reopening, which you think is still a positive tailwind, and of course the growth factor in terms of how strong that may be going into or for 2022. I would say in total, we are constructive on markets as we move forward. We are constructive on equities. They depending on how you look at them, they can actually be relatively favorable, especially if you look at it from a yield perspective in terms of what you get out of equities versus what you can get out of bonds right now. Lot to like from the economic reopening, still relatively supportive fiscal and monetary policies in the world, but again, contending that with some potential growth slowdown. We do think that growth will come down a bit, but still settle at a high level. But it's just how much will the market react to that? So a little bit of a short-term potential slowdown versus the medium-term, longer-term still being quite attractive. I'll touch. Sorry, go ahead, Lauren.
I was just going to ask you a quick question, Ryan. Last year this time, T. Rowe, we came out and said, World Series 2021 is going to be played in front of a sold-out crowd. And how we all pictured that, I think, was a little different than how the summer progressed. You talked about Delta, where we were kind of, oh no, here we are again. So with the Omicron variant now out, how are we viewing that? And I feel like your answer today would probably be different than the answer if we were talking last Tuesday, but curious if you don't mind sharing with the group some thoughts on that.
Yes, I'm very happy to be answering that question now versus a week ago, because a week ago it was very unknown, and that was something that the market fears. Any type of uncertainty or unknown is something that markets fear. And you saw the reaction with the massive sell-offs really across equity markets, and more so in those more cyclical value reopening type industries and names, because there was the fear that we were going back to a March 2020 type scenario. But fortunately, the news has been much more positive in terms of what we know about the variant, where the vaccines that have been distributed appear to be quite effective against the variant. The hospitalization rates, even in areas that are seeing an uptick in cases, such as South Africa and Europe, remain relatively low. So those are good signs that this is just another, I would say, speed bump, in terms of the recovery, and certainly something that we have to think about going forward in terms of what if there is another variant that happens to be more evasive of our current vaccines. But fortunately, where we are now is that it's something that we're just going to continue to live with and deal with, but we're not going to go back to a lockdown, economically negative scenario like we were in 2020.
So endemic instead of a pandemic, essentially. Okay, thank you.
I agree. Mm-hmm.
I think you definitely nailed it. I think one of the things that I keep hearing about that too is that as viruses mutate, they don't want to kill their host. They want to replicate. So a lot of times the viruses will become not as deadly to be able to replicate, and hopefully that's the way we're going. Hopefully it spreads, but it becomes less viral and have less illness with it.
Yeah, and it certainly seems to be the trajectory. I mean, the Omicron variant is much more transmissible from what it seems, but it's much more transmissible among the unvaccinated. But the effects are still relatively less. I mean, I would say that it's probably a good thing that this wasn't the first variant to come out, but the trajectory is, tends to be a little less severe over time. Now, it's not to say that something more severe could not come out. The number of mutations of the coronavirus is relatively high compared to past, but this is likely something, in the future that is going to be more like the flu, where you get a shot every year for the flu, and there are a number of different strains that they aim to treat on an annual basis. But it won't be what it was in 2020.
That's a great answer. Real quick, Ryan, too, with your international experience that you have on that, how do you see China? Because I saw that their trade deficit or trade surplus kind of narrowed a little bit, and then you have obviously our boycott that's coming up on the Olympic Games and all that. What is the impact that you're seeing in terms of U.S. markets, supply chain, all that, with kind of what's been going on over in China?
Yeah, I mean, China-U.S. relations are really interesting, and I think it's something that we're going to be living with for a very long time. We're the two largest economies in the world. We rely on each other for a number of different things, and we're likely going to be in a period where the U.S. and China have to both compete and coexist. I won't say cooperate, but I'll say coexist on a number of different levels. Now, we may see some onshoring or repurpose within the U.S. of certain industries like technology and healthcare, where we won't want as many pharmaceuticals developed or produced, I should say, in China or even India, and bring some of that production back home. But at the same time, if you look at some of our really important companies in the U.S., whether that's Apple, Nike, Texas Instruments, they derive an enormous amount of their growth and their revenues now from China. So for them, even from a government perspective, for them to say, you know what, we don't want you dealing with China or selling in China, that can have real strong negative effects for U.S. investors and for U.S. consumers. So it's going to be a pretty tight rope that I think is going to have to be walked by both companies and politically as we move forward. I think China is what it is and is where it is because it does have superior manufacturing capabilities, distribution, technology, labor force, and a lot of companies will continue to rely on China because of that. Now, again, certain things may change, but I would expect that we're probably going to have more headline risk to certain names and companies than actual material fundamental risk, because the private sector pushback to negating China from a growth perspective, for U.S. companies is going to be a hard political pill to swallow.
Awesome. Kaylee, I'm going to kick it over to you to see if there was any other questions that came in from the attendants.
No, I mean, I think we covered the major concerns, which would be the variants and the supply chain issues. So I think that was what was hot on everyone's mind.
Great. And what I will say from T. Rowe Price perspective from you guys is that your ability to be tactical in a market that is what we're dealing with right now is one of the reasons I love you guys. The ability for you guys to, as you said, focus on the fundamentals, pick and choose the right companies, know where to invest and where not to invest. Not all fund families do that. Some fund families kind of hold and kind of buy what they want and hold on tight, but you guys are, one of the best out there in terms of being more picking and choosing and being tactical. And, one of the biggest questions that I'm sure Kaylee and I get, everybody's hearing all this stuff about inflation and this, and then they call us and they're like, hey, why is the market still doing really well, but yet there's all this bad news? And, it does come down to fundamentals a lot of the time. So, I appreciate you kind of going over that a little bit too, which, hopefully will, resonate with some of our clients and, the people who are going to be watching this too.
Yeah, absolutely. Happy to help.
All right. Lauren, you got anything else?
I would just say thank you, Jonathan, and thank you, Ryan, for your time and your partnership with T. Rowe Price. It is our pleasure to provide actionable insights like Ryan did a great job of today. And bottom line, our goal at T. Rowe Price is to help your clients at incremental returns so that their retirement portfolios are healthier and stronger so they can enjoy their lives. So thank you for your time, and we appreciate the opportunity.
All right. Well, seeing that we have no more questions this afternoon, I'm going to go and jump in again. Ryan, Lauren, thank you again so much for coming out and helping out and trying to educate, our staff. Our clients. So again, I do appreciate that. Hope everybody has a good holiday season. We wanted to get this one in a little bit earlier in the month to kind of allow you guys to enjoy the end of the year with the holidays and everything. Plan on in January working on a presentation on Medicare and Medicaid, and obviously you can see the rest of our presentations for the end of the year here. Any questions on anything that Ryan went over this afternoon, feel free to reach out to either myself, Kaylee, or Paul. And as I said, I thank you guys for taking the time. I thank you guys for learning a little bit more about how the markets work. And have a great evening, and we'll see you next month. Take care.
Take care.
Thank you as well.